Now is the time to look at the second part of the session, which is about the eligibility rules of project expenses after the video that we have for you.
Greetings on my side to everyone who is watching us live right now and to everyone who will watch us later on the YouTube channel. As Nelida introduced me, I will be presenting the eligibility of project expenses. As most of you, as we can actually foresee that you already planned your objectives of your project, that you already set the result you want to achieve, match them with the activities which will help you to achieve them, and set deliverables and outputs of your activities. Now it's the time for you to start planning your budget. That means that you have to know which costs of those you want to plan will be deemed eligible. And this is what I will try to cover in this session. As Nelida also presented before, there is a variety of simplified cost options which European Commission is trying to enforce in order to allow deburdening, administrative and reporting deburdening of the project partners inside of the project during the project implementation period. So in the EUI, we also proposed a couple of options which our beneficiaries can use as simplified cost options, and I will try to explain which are those. So first of all, there are lump sums. As Nelida said before, there is a single sum of money which is provided to the beneficiary, and it's tied to something which we call payment trigger, and it's actually predefined terms of agreement on certain deliverable or output inside of the project. So where did we get this amount from? Is actually the answer is that we actually relied on the historic data and approximated the amount to what usually projects were using before on the real cost basis. So as you can see, we have a list of lump sums which project can use. And first of all, we have a project preparation. This is a period in which you will spend some resources, and we've foreseen 25,000 euros total eligible and corresponding to 20,000 euros ERDF amount for projects for their preparation of their project. The second one is initiation phase. We know that since we award the ERDF to the project and the actual start of implementation, there is also resources which will be spent in order to prepare project for the implementation. And this is why we provide 75,000 total eligible cost euros for initiation phase, which will be lasting for 6 months. Also, at the end of the project, as Nelida also mentioned before, there will be a project closure, so it will be a period of time in which you will be performing all the activities related to prepare your project for a financial and other closure, and for this we foreseen 20,000 total eligible cost for these purposes. Also, there is a novelty in this financing period 2021-27, and we have in each of the projects, you are required to build in the transfer partners, the 3 transfer partners, which you have to name by the end of the initiation phase. And for each of this partner, we provide a lump sum of 150,000 euros of total eligible costs to provide possibilities to transfer the knowledge and the solutions which were tested inside of the project implementation. The other type of simplified cost option is our flat rates. These are actually very attractive options, and these are basically specific categories of eligible costs which are identified in advance by programs, by initiative in this case, and they act as a percentage which is fixed ex ante to one or several other cost categories. In our case, we have the simplified cost option with the paired with the staff costs, where it amounts to 20% of the total eligible amount of real cost categories. We have office and administration costs, which were there before, but now also they amount to 15% of staff costs regardless of the type of the option you use. And also we have a travel accommodation which amounts to 5% of staff costs, and it will be we think it will be a big deburdening of the project partners to report these costs in the future. So when it comes to the staff costs, Nelida already said a big part of this, of the content of this slide, so I don't want to actually repeat her or myself later. So I will try just to be very focused on what is the most important. As I said just on the slide before, it's 20% of the total eligible amount declared by project partners under external expertise, equipment, and infrastructure and construction works. What is also important for you to know that it's not allowed for project partners to use this option if they foresee inside of their budgets the cost of works contracts or supply or service contract which exceed in value the thresholds of the EU public procurement directives. In the presentation you have a link to the directive I just mentioned, so I would propose you to check it so I don't actually now go and try to inform you on what are the real figures at this moment. When it comes to reporting, it's important to say that audit trail doesn't exist in case beneficiary or project partners is using a flat rate of any kind. That means that you are not required by the FLC auditor to check during the initiation, during the implementation of the project any document. What will be checked is at the initiation phase, the methodology used to calculate the flat rate of 20% for the staff cost. I made a small simulation of this calculation. I don't want to read out everything what is there, but basically I used the methodology to prepare the budget based on the work packages, which is how a monitoring system of EUI works at this moment. You can see that you take three cost categories which are calculated on the real cost basis and basically use the flat rate of 20% on that total amount. There is another simplified cost option type which we use, and this is a standard scale of unit cost, which means that the initiative actually proposes to use a unique hourly rate to the staff, which will be related to the project implementation, regardless of the position of the staff working. The project partner must apply the unit to the number of the total employees they will be including into the project, and they have to also count that the maximum number of hours of an employee cannot exceed 1,720 hours per full-time employee. I prepared for you also the calculation, basically the formula. You can see how hourly rate can be calculated. So we count that you will be able to propose us based on how you count with your staff inside of your organization or certain department. So the full mass of annual payroll divided by the full-time equivalent, so number of persons working or related to the project in any way, so being paid by the project, and divided by 1,720 hours, which is a maximum per year. When it comes to the audit trail, it's important to say that supporting documentation to be provided by project partners needs to be ready by the initiation phase. And there you will actually get also the help of first level control to ensure that your methodology of calculating, which you used during the phase of planning of the project, is actually solid and can be used for reimbursement of your costs. So employment information will be necessary. You will have to provide the contract or equivalent document together with the financial claims. As Nelida before said, the financial claims 1, 2, and the final payment, which is a lump sum based. So you don't have to provide anything. I made a simulation again using this option. You can see an example made for one work package where the person, 2.5 persons of full equivalent persons will be engaged for 36 months. So basically what I did is got the hourly rate, which you can see is 29.7. I transformed the months into the years, divided it with, or actually multiplied it with 1,720 and 2.5 full-time persons employed. And I got the amount for the work package 1. In continuation, you are requested to do this for all the work packages, in which you can have various combinations of number of persons employed during the project lifetime, and for different durations. So you can see how you actually, that this cost is not related to any of the previous costs, but it's actually calculated based on methodology which fits the needs of your organization. So when we talk about what is considered to be eligible, we need to say that salary payments and all the cost-related contributions, employment taxes, social security, everything related, all the obligations of employer towards the employee are considered to be eligible costs, and evidence will have to be provided to the first-level control auditors. Just to make sure that something doesn't slip or we don't cover the ineligible part of the cost, so any voluntarily payments which are not matching the calculation of accounting service cannot be considered eligible. Staff costs for employees who are not officially assigned to the project with a special annex, work order, or in the contract cannot be considered eligible. In this moment, dividends as something which we face in the one employee companies are not considered eligible. Overheads are considered to be already counted in the office and administration cost category. And agency workers also, it's very important to say that if you are trying to include into your among your workers on your project the people who you will be engaging through the agency, you have to plan it under the external expertise and services budget category. So now we covered all the simplified cost options. I hope they seem attractive to you, and that you will be happy to use them, since they really mean a lot of administrative and reporting deburdening. When it comes to the rest of the costs, we still remained tracking them on the real cost basis. So in principle, the amounts which are planned by project partners to purchase different goods, services, or to build something as infrastructural works, and these are still 3 budget cost categories: external expertise and services, equipment, and infrastructure and construction works. So what is important to know is that these expenses have to be planned and incurred in basis of the real cost, will be a subject of procurement rules. When we talk about the procurement rules, you know we have EU level, national, and institutional level procurement rules, and the most strict actually prevails. What is important to say also in this part, and Nelida also pointed it out in her part of the presentation, that expenses based on invoicing between partners are considered ineligible. And when it comes to the audit trail, the complete audit trail will be followed. So a first-level control will ask you for evidence of procurement, contracting, invoicing, and proof of payments to the providers of services, goods, or works. When it comes to so now we will try to actually break down this real cost on the basis of the type of the real cost we have available in our budget. So external expertise and services, in principle, these are usually professional services and expertise for which the project partner doesn't have the resources to cover, so they have to be purchased on the market. As you can see, there is a non-exhaustive list of examples we face on a daily basis by our project. So these are usually studies, concept notes, designs, trainings, promotion-related costs, communication, IT systems, websites, etc. What is important to know is that these kind of costs have to be necessary for project and should be linked to activities foreseen in the application form. So this is why I said before that budget actually has to be the last stage in planning of your project for the second call of innovative actions. When it comes to the external expertise and services, we have something which we call financial schemes, and it's implemented by the project partners to the benefit of the third party. Basically, when you give a certain monetary or in-kind value to the third party who is not officially project partner. So as I said right now, so it's distribution of financial contribution to third parties. Most commonly, this comes in the form of prizes, vouchers, or grants. What needs to be ensured as a principle is transparency and equal treatment, which means that in your application form, you will have to explain in detail how your competition procedure will run, how whom you are going to award or reject, and how you are going to monitor and control the system of third-party grants you actually gave up. When it comes to limits, usually we get the question on what is the maximum amount we can give to the third party. So it's up to 60,000 euros is actually per third party is the maximum you can give. It has to be connected to the work package, activity, deliverable, or the output, and described as such in the application form. There is no maximum limit on the total financial scheme you want to carry out, but it has to, again, fit your innovative solutions. There are two types of financial schemes. I will just very briefly try to say what is the point. In one of them, the project partner actually doesn't communicate or give the award to the third party, but it's invoicing outsourced provider who is actually delivering goods and services which are in the scheme describe how they will be provided to the third party. And only thing the third party does when communicating to project partner is actually giving the proof of reception of services or goods which were promised in the scheme. The second part is actually such where project partner is not connected to the provider, but he gives the certain grant or certain award to the third party, where he transfers the grant in euros, and the third party actually goes on the market and procures from the provider the goods and services which were promised and which were actually described in the application form. So among the real costs, we also have the equipment. So sometimes we are missing certain capacities, human capacities in terms of knowledge, and then we go to the market and procure services, external expertise. But sometimes we also miss a very tangible equipment, very tangible goods, which will help us to provide, to actually implement our project. So in principle, equipment has to be purchased, rented, leased, or in possession by a project partner to carry out a foreseen project activity or more project activities. Has to be covered. And the important thing is also that certain type of equipment is already possible to cover under office administration, and you should avoid to try to cover them twice in your project budget. So be careful of that. So what types of equipment we have? So the initiative actually breaks down the type of equipment to two basic categories. One is accessory equipment, which are tools and devices used to carry out project activities, and they are basically you will be able to report on depreciation of the value of this kind of equipment. While we have at the same time investment equipment, which are tools and devices or goods considered as project investment and also as a project result at the end of the project implementation. And with this kind of investment equipment, you will have to report, you can report the full cost and be reimbursed for the full cost. What you have to be aware of that here, ownership and durability principles apply. I will a bit later explain what this is. When it comes to the audit trail, the full audit trail, since this is a real cost basis cost plan, the full audit trail will be requested at the time of submission of financial verification of your financial claims by the first level control colleagues. The third type of real cost is infrastructure and construction works. As I mentioned before, there are different cases. In this one, with a big budget, as Innovative Actions actually provide 5 million euros of ERDF, usually the projects are able to involve infrastructure and construction works into their project. And in the principle, this kind of costs are eligible. If they don't fall in the scope of any other cost category, if they are crucial for the achievement of the project outputs, results, and later objectives, the full purchase price is eligible, so depreciation during the project implementation will not be considered. And also, as I mentioned before, ownership and durability principles have to apply. When we are talking about what this could be, you, as we saw your structure among our participants, you would already have the idea, but these are purchase and provision of land. As Nelida says, maximum 10% of the total project budget value, purchase and provision of real estate, site preparation, renovation, building permits, building materials. As you can see here, there are also included some services which can be included into infrastructure and construction works. When it comes to the audit trail, again, since it's a real cost, this will be backed by the complete audit trail, so full documentation related to the public procurement related to the infrastructure and construction works. Now we come to the part which actually you have many pages in our guidance to read about, and it was a very kind offer from our colleague Nelida to actually point out the articles related to the certain financial rules. As this one, for example, we have investments ownership and durability principles. We mentioned it a couple of times. So if you purchase something inside of your project, you have to make sure that it's sustainable, that it's used sustainably throughout and after project implementation, and you have to ensure that it's maintained properly. All investments in infrastructure and equipment, which are co-financed by the ERDF inside of your project, have to ensure that this principle is met. Ownership and durability conditions must be presented in the application form, so you have to actually describe already before you are awarded the ERDF how you are going to meet this principle. So we can break them down to ownership and durability. Only project partners can become the owners of project investments, and only those project partners who are owners of the investments or other partners inside of the project have to remain the owners for at least 5 years following the final payment to the main urban authority. Durability, when we talk about the durability, project investments must remain operational, which means that the nature of their use by the target groups cannot change at least 5 years after the following or after the final payment to the main urban authority. So now let's say the funny part is the public procurement, which basically is a set of rules which you have to follow when trying to actually in certain way realize your costs. What we know by the principle, and you can check it in the guidance also because there is a big section on the public procurement, each partner must be aware and must obey the applicable public procurement rules, no matter on what level they are. The obligation to follow the public procurement must be also well documented. The first level control colleagues will ask, auditors will ask for this, for the audit trail, so make sure that you are documenting and are having properly your public procurements. Sometimes it happens that even the procurement contracts which are pre-existing, so you have some regular public procurement in your institution, have to be also, the audit trail has to be provided, even if they incurred basically before the project start date. also, it's very important to say that even when their direct contracting is allowed, so with certain types of beneficiaries of project partners, like associations, like small businesses who are not obliged to follow public procurement rules, we have a set of conditions which they have to meet in order to prove that their procurement was done in a proper way to the first level control. This is where the market research actually comes in. So project partners who do not fulfill this obligation to do the public procurement, so are not obliged to run the public procurements for their purchases. For the initiative, any contract higher than 10,000 euros, excluding VAT, has to provide the full audit trail and documentation of how the market research was done in order to contract certain service or good or infrastructure and works. It has to be ensured that the research, so minimum 3 offers were received prior to the selection of the service provider. When it comes to the in-house contract, there is also, in certain institutions, there is a separate institution, and the project partner institution basically is obliged or has already established a partnership in a way that they procure certain goods and services from them directly. And I have to just say that please check the guidance for the 3 very strict conditions which have to be fulfilled in order for this kind of costs when planned to be considered eligible. It's limited to 50% of the budget of the concerned project partners. That's also one of the limits which you have to follow if this is a case in your organization. So as Nelida said before, so I don't want to repeat her too much. So 80% of the total project budget is actually provided by European Urban Authority as 80% of ERDF funding, but there is a 20% which a partnership actually has to provide from their own sources. This can be a monetary value. This can be simply a financial value you have on your bank accounts, but it can also be a non-cash contribution. So it can be in kind, and it can have a monetary value, but it has to be given. It can be given for free or free of charge to the project. So it can be certain goods, real estate, land, as before Nelida mentioned, unpaid voluntary work, equipment, services, rents, and this all can be actually expressed as in-kind contribution of the project partners. It's limited to the maximum of 20%, as I just said. And what is required from the project partners, it's necessary to carry out the project and achieve the project objectives, as with all costs which are deemed to be eligible. It shouldn't come from the other EU funds, so other EU sources. Its value has to be independently assessed by an expert. There is sometimes a possibility to engage your accounting service inside of your institution, but mostly we receive the value independently assessed by the expert. If you want to make this kind of in-kind contribution eligible, it has to be included in the application form. As it says on the slide, it has to be in the contribution section and also has to be planned inside of the work plan budget. What is important to say, so where do you actually fit this kind of contribution? It has to be allocated basically under the external expertise and service, equipment or infrastructure and work cost categories, meaning that you have to actually be able to put it under one of the real cost basis cost categories. There is one also very attractive, very popular question. Usually it's a state aid. So basically what it is about, what the state aid rule actually talks about. So the European Union is a common market, and basically this rule ensures that the EU funds, that the funds actually coming from the public sources are not disturbing the regular competition on the market of the goods and services inside of the European Union, meaning between 2 EU member states. So there are 5 conditions for state aid recognition. So you can try to recognize this kind of situations even before, during the project planning. It has to be concern the economic activity of project partners. It has to be concern selectivity, so the project partners are usually selected not on a very objective basis. It has to concern the public resources. It has to give the advantage to the project partner and has an effect on the competition and trade on the national, at least national scale. So EUI Innovative Action projects must be designed in compliance with the state aid rules and at all levels. So each of the project partners for themselves has to flag this to the main urban authority, and main urban authority has to revise the possible problematic situations and those and those project partners who would fall under the state aid rule. So ERDF budget of 80% is by default immune from the state aid risk, so you're never concerned of the 80% given by the EUI. What you have to focus on is the 20% of public contribution, so it has to come from the public sources. It has to be it has to involve the economic activity of these project partners, for which 20% of public sources is planned. In state aid risk, if in case you ran into the state aid risk, there are also, inside of our guidance, there are 5 conditions. All the 5 conditions are met, and the partners can explore the options which they have to report this kind of situation or to get the feedback from the authorities which concern these issues. Well, thank you very much. I think we have a slide of questions, so I will just ask my colleagues to continue. Mm-hmm.
Thanks, Rinka, to make it really more interactive, this part of the presentation, because it's too many rules about eligibility of expenses. We have different quiz questions. We need your participation into our Slido, please. So, Maya, could you help us with those quiz questions we have for our audience?
Thank you, Nelida. Thank you, Zrinka. We have 2 quiz questions for our audience, so please do get on the Slido. Our first quiz question is about the standard scale of unit costs. The question is the standard scale of unit costs hourly rate for project partners calculated automatically by the EEP system for project partners selecting this option? So to repeat the question, is the standard scale of unit cost hourly rate for project partners calculated automatically by the EEP system for project partners selecting this option? And we've started to get some answers through from our audience, so thank you very much. Quite a strong position here, although now it seems to be evening. So I think I will now hand over to Zrinka for the right answer.
Yes, I would say most of you are actually right. So as I explained during my presentation, the standard scale of unit cost is offered as a formula by the permanent secretariat, but the hourly rate itself has to be calculated and provided by the project partner who wants to use this option.
Wonderful. Thank you, Zrinka, for answering that question for us. Moving on to our second quiz question. Is the amount awarded to a third party via a financial scheme considered as a lump sum, and thus no audit trail must be provided to the first level controller? So to repeat the question again, is the amount awarded to a third party via a financial scheme considered as a lump sum, and thus no audit trail must be provided to the first level controller? So we've just received our answers. Again, a strong message here. Zrinka, I think we're ready to hand over to you for the answer.
Yes, thank you. The right answer is, of course, no. As I said during my presentation, again, financial schemes are actually planned as external expertise and service type of costs. So basically, it's important to know that they will be assessed as a real cost, meaning that a full set of documentation related to the audit trail will have to be provided to the first level control.
Thank you, Zrinka. Now we will take 2 audience questions. Please, Maya.
Thank you. Yes, we are now moving on to our audience questions. Please keep them coming. If we haven't got your question with us now, we will have 30 minutes at the end of the session. So our first audience question is, as MUA, Main Urban Authority, our staff counts more than 6,000 employees, some working on tasks not at all related to the project topic. Do we need to include all of them into the equation for our hourly rate? Srinka, have you got the answer for us?
Yes, the answer actually depends on how your organization or institution works, meaning that we are strongly enforcing the project partners to work with the methodology we provide to them and to assess if it makes sense to calculate, to take into consideration the full mass of salaries of the whole organization, or in case of the bigger organization as such, only a department or unit. Thank you, Maya.
Thank you for your answers, Srinka. We're now ready to move on to our second audience question. Are there any regulations regarding the ownership of equipment or investment after the project closure? So that's, are there any regulations regarding the ownership of equipment or investment after the project closure? Over to you, Srinka.
Thank you, Maya. As I said, again, during my presentation, there is an ownership and durability principle all the project partners have to follow in case they are becoming an owners of equipment or certain infrastructural items. What is important to know that at least for 5 years after the project, after the final payment to the main urban authority, project partners have to remain actually owners of the investments.
Thank you, colleagues.